Hello, my name is John Charbonneau, and I'm a licensed mortgage professional with the Mortgage Group in Vancouver, British Columbia. I specialize in helping homeowners across Canada determine what type of mortgage is best suited to their individual circumstances and then negotiate and arrange the best mortgage for my clients from a variety of financial institutions, including trust companies, banks, credit unions, life insurance lenders, and pension funds. In today's video, we are going to talk about variable rate mortgages. This is a mortgage where the interest rate changes during your term as opposed to having a fixed interest rate for a set number of years. Variable rate mortgages have and continue to be popular ways to finance a home. They are also known as adjustable or floating interest rate mortgages. As a result of the world liquidity crisis, there have been major changes to variable rate mortgages commencing in the fall of 2008. If you are considering a variable rate mortgage, partly because a friend or family member has suggested that you would save much more interest compared to a fixed rate mortgage, you need to take what I am about to tell you into account, because there is a good chance your friend is not aware of the substantial changes that have recently occurred. Here's a brief introduction to how the interest rate is determined with a variable rate mortgage. Firstly, all variable rate mortgages are tied to what is called the prime lending rate. The prime lending rate from one lender to another is virtually the same on any given day. At the time of this recording, the prime lending rate is 2.5%. The prime lending rate changes when the Bank of Canada makes a change to what is called the Bank of Canada rate. The Bank of Canada lowers the Bank of Canada rate to stimulate the economy, and it raises the Bank of Canada rate to increase the cost of borrowing and slow down inflation. Prior to September 2008, it was common to secure a variable rate mortgage that had a discount below prime. The typical formula was prime minus 0.75%. So if you currently have an older variable rate mortgage, your interest rate would be about 1.75%. In the fall of 2008, lenders reacted to an increasing cost of borrowing and changed the formulas to determine the interest rate on newly created variable rate mortgages. Rather than the rate being a discount below prime, the formula changed such that it is now prime plus 0.8%. This means that a variable rate mortgage would now be 3.3% compared to an older variable rate mortgage at 1.75%. The appeal of variable rate mortgages is that historically, over the long term, you pay less interest compared to locking in for 5-year fixed rate terms. As a result of two recent changes, borrowers may not achieve these favorable savings in the short-term future. The first big change is that the difference between the interest rate on a variable rate mortgage and the interest rate on a fixed rate mortgage has decreased. Thus, the potential rewards are not as great. The second major change is that the current rates for a 5-year fixed rate mortgage are at an all-time low. If you take a variable rate mortgage today, the initial rate will be lower than the current 5-year fixed rate, but the variable will eventually rise above today's 5-year rate, and you lose the advantage. The general school of thought says, if you have an old variable rate mortgage where the rate is below prime, hold on to it. But if you are negotiating a new mortgage today and have the choice between a variable rate and a fixed rate, the conservative borrower should choose the fixed rate, and only a really aggressive borrower, someone that can afford to be wrong, would choose a variable rate. If you choose a variable rate, be prepared to watch it increase as soon as the economy begins to grow. It won't take long before the rate you are paying on a variable rate mortgage increases above today's 5-year rate. You can always convert a variable rate mortgage into a fixed rate mortgage, but keep in mind that there is a strong likelihood that the rate you are going to lock into will be higher than it is today. There is no guarantee that taking a variable rate in today's interest rate environment will save you more money compared to locking in. The changes made in the fall of 2008 make it less likely that you will come out ahead over the next 5 years. There are strategies that you can implement to reduce the risk, and I would be happy to discuss them with you during a private consultation. If you would like more information about how I can help with your financing needs, feel free to call or write. Thanks for watching, and take advantage of our additional mortgage videos, all of which are designed to save you money.